Happy Monday, everybody. Welcome back to several of you who were in Atlanta last Friday. So for those of you who are in Atlanta, I just want to confirm that you guys are okay with the commodities exchange that was mentioned in the homework assignment on Friday. I did not hear any discussion about it. So are we all in approval of the commodities exchange that we agreed upon? Any people who are opposed to the commodities exchange? All right, so those people who were not here on Friday have agreed to allocate their homework points to the people who were here on Friday. So I would agree to that. Okay. Thank you very much for your generosity. That was very, very kind of you. And yeah, so yeah, obviously I'm kidding, but it's always fun to hear if I get emails back. Usually when I get an email back for somebody talking about when I made that joke in class, it's an emphatic, no, I do not agree to give my homework points to other people. But yeah, I wouldn't do that. You all worked hard to get your homework assignments done. My grader says that all the homework assignments were turned in and they got 5. So congratulations. Thank you very much for that. Do that the entire semester. Well, everything will be great. I'll be happy. But yeah, so let's go ahead and get started. We're going to talk about risk assessment today. Let's still talk about risk assessment. So um, I'm going to start out with a classroom analogy, and I want to use this as a basis for talking about something. We're gonna work back on our way to this. Oh, by the way, before I get started, we do have quote unquote a discussion on Wednesday. There is no advanced preparation for the discussion. You will just need to show up and be very prepared. I will actually call on some volunteers. So think about in your heart of hearts if you really want to volunteer for an opportunity to be part of the discussion. Everybody's going to be part of it no matter what, but some of you are going to volunteer for special positions. And if you don't volunteer, I'll pick you out of the audience. So there you go. Yeah, all right. So audit classroom analogy. Let's go ahead and say that I contend that my students are knowledgeable about auditing, which is a contention that's pretty natural to make because Dr. Caden's going to come to me at the end of the semester and said, all right, did your students do what everything they do? So yeah, and I taught them to the best of my ability, and I believe that my students are knowledgeable about auditing. I make that contention every semester, all right? Is it possible I can make that contention when you guys actually did not learn about auditing? Is it possible that I could make that statement? And so, yes, is it possible that I could believe that you're knowledgeable about auditing when you're not? Like, yeah, I say, yeah, my students are very knowledgeable. Ask them anything about auditing, and Dr. Caden, much to her chagrin, goes and she finds out information about auditing. She actually has to search online because she's tried to avoid it for her entire career. And she goes and she says, all right, you tell me what one of the management assertions are. And you say, I don't remember. It was all a blur. She goes to another student and asks like 15 students in the class, and everybody has the same context as, yeah, I don't remember anything. I kind of tuned Dr. Barnes out because he had that monotonous voice and never ever raised his voice at any point in time during the semester. And it was just hard to learn. Yeah. So I could actually say that everybody learned something, and then you all would show contrary evidence, which I don't believe will be the case. I believe everybody will have a strong base of auditing knowledge, but it's certainly possible, right? Certainly a possibility that that could happen. So to that same end, an auditor can go in and do an engagement, perform an engagement, and they could actually attest that that engagement was completed to the best of their ability, and everything looks good when there's a problem. And that underlies this idea of audit risk, okay? We talked about this back in the first lecture. We talked about this concept, but it's the risk the auditor expresses an inappropriate opinion when the financial statements are materially misstated. Specifically, that inappropriate opinion would be that the financial statements are free from material misstatement, or free from material misstatement with the exception of certain items. But basically, there's a problem when in fact they say that there's not a problem, all right? And has anybody taken any science courses while here at Truman State? Talked about type 1 error, type 2 error. You remember those from scientific testing? Type 1 error is where you say that there's a problem when there is no problem. That's not what we're talking about here. We're talking about type 2 error. Type 2 error would be that there is a problem, or we say that there's no problem when in fact there is a problem. Okay. So what is the risk here? Well, here's the deal, is that if we have an unqualified opinion with materially misstated financial statements, then we have the planet Earth. I have tried to fix this animated GIF every single semester I do this, but basically, come on, work for me. There we go. All right. Yeah, there we go. It works. Okay, fantastic. I thought it was going to work, but yeah. If you have an unqualified opinion, but the financial statements are materially misstated, it's going to result in a catastrophe. Maybe not as grand as this catastrophe right here, okay, but certainly problematic. In fact, in my graduate class, we're going to be talking about one of these scenarios where an auditor's issued an unqualified opinion on extremely materially misstated financial statements. This was back in 2002 for a company you may have heard of called Enron. All right. So was that a catastrophe? Yes, it actually sent the capital markets across the globe into a spiral. It's not quite as severe as this particular scenario right here, but still pretty severe, still pretty problematic. So let's go ahead and talk a little bit about how we assess audit risk. Now, usually when we talk about audit risk, it's assessed at the assertion level. You're going to hear me talk about assertions a lot moving forward in this class. It's assessed at assertion level. We've already talked a little bit about this, but assertions are expressed or implied representations made by management regarding the recognition, measurement, presentation, and disclosure of information in the financial statements. Now, I've already used this simple example, but I want to use it again to reinforce what we've talked about. Example, the financial statements contain an account balance of $30 million for inventory. So you look at the financial statements, they say $30 million inventory. You should be able to identify somewhere in existence on this planet somewhere, the client has physical possession of $30 million of inventory. So that means that the inventory exists and that $30 million is not an arbitrary valuation, that we can actually determine that $30 million is an appropriate figure to assign to that inventory. All right, that's basically what we mean when we talk about assertions. And we are in the process, as our auditors, we're going to be testing these assertions to determine if these assertions are valid and accurate. Now, we're not going to get too much into the evidence collection state yet. Next week will be a banner week because we're going to talk on Monday. We're going to start our discussion of assertions and evidence gathering. That's when it's all going to come together. But for right now, we need to understand that when we assess audit risk, we do so at the assertion level. We attribute risk based on these expressed or implied assertions that management makes. It'll become a lot more clear once we actually go into the deep depths on what the assertions represent. So the assertion level audit risk consists of, well, two basic criteria. You could separate it down to three, but we're going to talk about two basic. The functions of the audit risk are going to be the risk of the relevant assertions related to the financial statements contain misstatements that could be material to the financial statements. All right. This idea is called risk of material misstatement, which we're going to talk about here in just a second, and are comprised of two separate components, inherent risk and control risk. Now, we're going to get into a lot more detail as to what these two concepts mean here in just a moment. All right, so that's the first component. Second component is going to be the risk the auditor will not detect such misstatements, okay? And this is going to be called detection risk. So the thought behind this is that audit risk is comprised of as a function of two separate items. This risk of material misstatements, that the financial statements contain misstatements that could be material to them, and then the risk the auditor will fail to do their job properly and find these material misstatements, okay? That's what we're going to characterize audit risk as. Now, that seems pretty simple and straightforward, and it's not difficult conceptually, but there is a lot that underpins these particular concepts. So let's get started on this, all right? So I want to start out, I want to talk about this idea of inherent risk, okay? Inherent risk. Inherent risk is the susceptibility of assertion in a counter disclosure or misstatement due to error, fraud, can be materially, either individually or when aggregate with other misstatements for consideration of any related controls. All right, that's a mouthful. That's probably more than you want to memorize. So let's just go ahead and say, this is the fundamental risks related to an entity's operations. All right. Now, going back to my analogy, are there inherent risks associated with this course? Remember, I am making the attestation. You all are learning auditing. I don't want to make that assessment and have in fact to find out that you didn't learn any auditing over the course of the semester. So I'm making the assessment. You all are knowledgeable about auditing. What are some risks that are relevant just to the nature of this course as a whole? Okay. Well, first of all, there's a lot of information about auditing out there. We're going to cover a lot in this course, and it's not even going to scratch the surface. Okay. Also, it is constantly changing and evolving, as anything that's very technically and professionally challenging is going to change over time. I try to keep up with it. Some of the times I miss it. It does occur. And let's be honest, auditing can be a little bit dry at times, okay? Everybody signed up to be an accountant and says, oh, I'm good at math, all right? So you like working with the numbers, and then I come in at the beginning of the semester and say, yeah, guys, there's no numbers in this course. And you're just like, oh, okay. So yeah, it can be a little bit dry and tedious at times, and I accept that. Alan Davis, the guy that I keep poking fun at, and nobody's interacted with in this room, former tax attorney who taught here at Truman State, he used to say auditing is boring, and I said yes, and it takes an exceptional professor to make it interesting. Yeah, that was my response for him. Okay, but auditing can be a little bit boring. So let's think about how we can characterize this according to the real world. Okay, are there inherent risks in the real world when we think about entities that we might be auditing? Probably so, probably very significant risks, okay? If we're talking about any large business, they probably have a high volume of transactions, okay? A large volume of transactions. They perform complex tasks and calculations, all right? They use a lot of estimates in their accounting. There's the risk of technological obsolescence, which will become a theme that over this course of the semester. We're going to talk about technology and obsolescence and how that affects a lot of risks and evaluation concerns that we have with the organizations. Some companies may have working capital concerns, particularly if they're at a point in time where they can't raise enough revenues or they can't convert that income into cash. All right. What about increased business risks? Have the business risks in an environment changed over the past decade for most companies? Yeah, we have this thing called cybersecurity. You guys heard about that? You know, it's kind of affected risks in organizations. Ransomware attacks. I don't know. Ransomware attacks seem so far away from Truman State. That could never happen here. Okay. Just doesn't seem like something we'd have to be exposed to. Oh wait, yeah, okay. So yeah, certainly some concerns, some inherent risks in organizations, okay? But we know those risks exist, okay? We know those risks exist. And like any good accounting student, you know that we have to proactively respond to risks. What are those things that we call that are proactive responses to risks? Controls, that's right. You remember from AIS. Everybody said it in a loud voice. At least that's what I heard there. A loud cheering voice saying controls, okay? Yeah, controls. So the problem being is that these controls should address the risk, but is it possible the controls themselves could be faulty? Yes, that is a concern. That is a concern. So control risk is a risk that a misstatement could occur in assertion or a counter disclosure that could be materialized individually when aggregated with other misstatements will not be prevented or detected and corrected on a timely basis by the entity's internal controls. Simplified, risks that are present after an entity takes action to address its inherent risks, okay? So I know that there are risks associated with this class. I know that sometimes, so very occasionally, some people might just kind of be distracted instead of thinking, okay, I really need to understand these management assertions to be kind of like, what am I going to do after class? I'm really hungry. Or maybe, what am I going to do this weekend? Or what am I going to do with my life? You know, your mind may wander, okay? It might happen. So are there ways that I can address these risks that make sure that you all are learning auditing? Yes, there's some ways. So some examples. I give assignments and exams, okay? All right. So let's think about those assignments and exams. Could those be appropriate controls to try to make sure that you're learning auditing? Yeah, if you don't turn in assignments or you do poorly on exams, I can go to you and say, hey, what's the deal? What's going on? You don't seem to be taking interest in the class. Says, well, it's auditing. I said, I get that, okay, but it's required for your degree, okay? So I make sure you complete your assignments, do your exams. So is it possible that I could fail in my controls? I could say I failed to give assignments or exams. That would be the dream right there, right? You come to class and you just kind of learn for the sake of learning. Actually, if I failed to give assignments and exams, that would be kind of like nobody would be here at all. They'd be kind of like, yeah, there's no point. But yeah, that would be one failure. Also, a possibility. I give you assignments and exams, but they don't actually teach you about auditing. Okay. It's like, okay, you see a test question. What is Dr. Barnes' favorite food? I bet everybody knows that. Cheeseburgers, yeah, cheeseburgers, yeah, everybody knew that. I heard that in a loud roaring voice too. Okay, yeah, so that's really entertaining and fun information to know, but does that teach you anything about auditing? Not directly, okay? The reason I mention this, so we think about the way that we consider controls within an organization. Controls can fail in one of two ways, all right? So first of all, the controls could be present, or if they're created, they're not really relevant to what they're supposed to be doing, okay? So either you fail to create a control in a certain scenario, or you create a control, but it doesn't address the risk that you it's designed or should have been designed to address. We call that a deficiency in design. All right, a deficiency in design. The control is not designed properly to address the risk that it's supposed to address. All right, so that's one possibility. That's the example of that is I don't give assignments or exams. The control is just not present there. It's not addressing that particular risk. Other possibility, control is present and if followed would be great, but for some reason it's not operating properly. So does everybody remember segregation of duties back from AIS? Says yes, CAR, Dr. Barnes. I remember CAR. Don't remember what it stands for, but I remember CAR. Okay, which is good. Okay, we're halfway there. Custody, authorization, recording. Those three types of transactions have to be separated, or those three areas of responsibilities have to be separated out. Is it possible you could have three separate individuals responsible for three separate areas, and they say, I don't want that responsibility. I'm going to give it to that person. And then everybody had one person has responsibility for all three areas. Yeah, the control is present, but it's being ignored. That's a deficiency in operation. Deficiency in operation. The control is present, being ignored. So I give assignments and exams, but I don't give you information about auditing, so you don't learn about auditing. That's the example there. So again, two possible scenarios that controls could fail: deficiency in design, deficiency in operation. We're going to come back to those when we start talking specifically about controls. That will be very, very relevant. For right now, you need to know that there's two possible ways that control can fail. All right. When we talk about the levels of inherent risk and control risk, these are functions of the entities and environment. We as auditors will assess the level of inherent risk or control risk. We will make a determination of what we think the level of these are, but we have no control over what they are. These are functions of the entity and its environment. So we walk in and we see a really, really busy environment with a lot of complexity, a lot of really, really crazy transactions, a lot of chaos, and we say inherent risk is high because we can observe what's going on in the organization. Then we go and look at controls and we do some controls testing and we say, all right, control risk is high. The controls are not effective in addressing this particular problem. All right. We don't control those. We don't change any of those. We don't have any effect. We are merely assessing what we believe is in place. That's our responsibility as auditors. Okay. Now, auditing standards refer to the combination of inherent risk and control risk as risk of material misstatement. Okay. Risk of material misstatement. You're going to hear me talk about that as a lot. So basically, what is out of our control is the risk of material misstatement. And we're going to see that characterized here again together. All right. But we do have another component, remember, because we said the first component was the risk of material misstatement. The second risk is the risk the auditor does not do their job properly. All right. So I'm going to do something devious, something I do every semester and I get a little bit of joy out of. Okay. I'm going to make Dr. Caden an auditor. Okay. So we're going to talk about detection risk. The risk of procedures performed by the auditor to reduce audit risk to an acceptable level will not detect a misstatement that exists that could be material either individually or aggregated with other misstatements. In other words, any remaining risk after planned audit procedures. Okay. So let's just say I have not done my job. All right. I asked you guys questions about cheeseburgers or who's going to win the super game that's coming up. I heard the home team won the super, or is going to the super game. Okay. So yeah. Who was going to win the super game? And I asked you a whole bunch of relevant questions. And then Dr. Caden comes to me and says, all right, did they learn about auditing? I say, yes, they learned about auditing. Okay. So she looks at evaluations and your evaluations like Dr. Barnes kept talking about inane nonsense. Okay. Or Dr. Barnes is not teaching anything about auditing. I demand a refund. Something along those lines. If she does her job there and taken seriously, she'll realize that I was just completely and totally not following the rules. I was not doing the job. But let's say Dr. Caden's is like, you know what? Dr. Barnes has been here for 10 years, so he's not doing his job by now. I don't have any recourse anyway. So she doesn't read my evaluations. She doesn't do any follow-up work. And it turns out this semester, I just totally just decided not to do any work. I'm just kind of like, you know what? I've done work for 9.5 years. I'm done for near this part. You know, I'm done. They can learn their own about auditing. They're all smart. They can learn it about their own. Okay. That would be the problem is if she doesn't do her job properly, then there could be a risk that exists there. So as an auditor, Dr. Caden has to do her job. She has to make sure that I'm actually teaching you guys auditing. She has to look at those evaluations, look at my teaching evaluations to see what you all say. And if you all say, Dr. Barnes did a great job, although he kept talking about cheeseburgers. Okay. I'm going to make you very, very hungry. That's my goal. Even if you've had lunch, make you very, very hungry. That's my goal here. All right. Or I apologize if you're a vegetarian, then I may just offend. All right. But talked mostly about auditing, talked about things that was relevant and interesting. Okay. So basically, this is what she's got to do. She's got to determine what amount of work she have to do to determine I've done my job. This is this idea of detection risk. So detection risk is determined by the effectiveness of audit procedures and how well the procedures are applied by auditors. Okay, by the auditor. So what amount of work do we have to do to get any remaining risk going? Now, I want you to make a note of this. Remember I said control risk and inherent risk, we had no control over as auditors? Detection risk is the only thing the auditor can control. All right. It's the only component of the audit risk equation that's controlled by the auditor. We make the determination of how we're going to set detection risk. This will subsequently set the scope of the work that we're going to do a little bit later on. All right, so we're going to come back to this. I do want to talk about a related concept that's a little bit of not part of the audit risk model, but is kind of part of this. This has to do with this idea of engagement risk. Okay, so in addition to audit risk, the auditor is subject to engagement risk. It's related to the auditor's model, but not considered to be part of it. All right. Engagement risk is the risk the auditor is exposed to financial loss or damage to his or her professional reputation from litigation, adverse publicity, or other events arising in connection with the audited financial statements. Okay. And it cannot be directly controlled by the auditor, though some control can be exercised through the careful acceptance and continuance of clients. We talked about continuation and acceptance last week. And I said, what is the risk if we accept a client that is a bad client? We could be subject to litigation. We could be subject to scrutiny. Could have a liability associated with that, which is certainly a concern. So the auditor may say, this is not an area that I want to move into. This is not an area of audit that I want to subject myself to my risk to professional reputation. So this is an interesting story, and I apologize, but this is it's a very explicit example, but it's a very good example, okay? So has everybody heard of the company Grant Thornton, the audit firm Grant Thornton? They're a public accounting, national accounting firm. A few years ago, they made the somewhat controversial decision that they were no longer going to be the auditor for a company called MindGeek. Okay, and I only know about this company because I read about it on a blog, but I did not know this at the time. I had heard of this other organization, but MindGeek, they're responsible for a website that is very, very notorious. I'm not going to tell you the name, but I'm just going to say it's a hub for adult content. Okay. Can everybody put 2 and 2 together for that? Okay, a hub for adult content. They own that particular website. Okay, and Grant Thornton said, "This is not the type of business model that is conducive to our operations. We do not want to be associated with this." They felt that there had reputational risks associated with this engagement, so they made the decision they were no longer going to be the auditors. Okay, I don't know who the subsequent auditor was, but Grant Thornton followed this idea of engagement risk and said that this is a reputation concern for us. Now, you may argue that actually goes well beyond their finances. I don't know anything about the finances of this company, but they may have been well in order, but the reputation and the business model was enough for them to assess this risk. So again, very explicit example, but a very compelling example of this concept. All right, moving back to the audit risk example, okay? So the audit risk model can be specified as a function of everything we've talked about before. Now, it's not literally equal AR equals RM times DR. This is more of a conceptual example. Could we actually assign quantities to this? Yes, but we're not generally not going to. We're going to think about this from the perspective of usually qualitative analysis. Or audit risk is a function of inherent risk, control risk, and detection risk. Okay, it expresses the general relationship of audit risk to the auditor's assessment of risk and material misstatement, which is inherent risk and control risk combined, and the risk that the auditor procedures will fail to detect a material misstatement, the relevant assertion, which is our detection risk concern. All right. Now, I want to make a few notes here because there's some things that we're going to need to know about moving forward, okay? First of all, when we think about audit risk is usually going to be a constant for the most part. The assignment of audit risk, which makes sense because it doesn't make it, there's not really a reason why we would want to conduct an audit and then go to our client. And the client says, I'm okay if you set high risk for audit, okay? That means we're okay with a whole lot of material misstatements. That would really kind of defeat the purpose of an audit. So audit usually is going to be set at low or very low. It's effectively a constant for our purposes. Now, the reason I mention this is that we're going to talk about attestation and assurance a little bit later in the course. We're going to look at a similar model. That gets thrown out the window because certain types of attestation services can have higher levels of risk, okay? But for right now, audit risk is going to be low, very low. Secondly, I want you to think about how we actually characterize this. You would think that inherent risk and control risk could be trade-offs for one another. And that's not necessarily true. Generally, what we're going to set risk and material misstatement at is going to be characterized by what the lowest level of inherent risk or control risk is. And it always confuses students when I say that because they're a combination. And so it should be if like one is low and one is high, then it's a moderate, right? Okay. Let me kind of try to explain it to you in a little bit of analogy. This is one of my favorite analogies this semester, okay? So this is going to be Club RMM, the newest, hottest club in Kirksville if you like to go out on the weekends, okay? And you know it's cool because it's got DJ Double I spinning the tunes, okay? That's what Dr. Eisen does for one of his side hustles, all right? Can you imagine Dr. Eisen as a DJ? That would be so fun. All right. So we've got two bouncers, okay, two doormen, I should say, two doormen that are kind of controlling. So one actually controls who goes in the waiting area, the other one controls in the club. So Irving, IRVING, controls who comes into the waiting area. And then Craig, CRAIG, controls who goes into the club. All right. Now think about what happens if they let the same number of people in every hour, then that's who's going to get into the club every hour. So if like they'd say 10 people here, 10 people here, 10 people are going to get in the club every hour because it's going to be controlled amount. But let's say that Craig gets really, really upset and he's saying there's too many people in the club already. I'm only letting one person in an hour. Doesn't really matter how many people Irving lets in. They're not getting through this door to get in the club. Okay. All right. So the lowest level is dictating who's getting in the club. Let's reverse it. Craig finally has a change of heart, says, okay, I'll let like 50 people in. But Irving's kind of like saying, no, nobody are going to the waiting area. I'm only letting one person in. Okay. Assuming there's nobody in the waiting area, still only one person's getting in the club. Okay. So that's what I mean when I say that what dictates what happens to RMM is dictated by what the lowest level of IR and CR is. All right. Now, in most of our examples for this particular course, we're going to set inherent risk at high because most of these organizations we're going to be auditing are going to be publicly traded companies that are going to have naturally high inherent risk. So generally speaking, we can say inherent risk is going to be characterized by whatever control risk is. But it's important to make that characterization and have that understanding because it won't always be the case. Particularly as we start looking at more complex scenarios, especially for smaller companies that could have small levels of inherent risk. Like, for example, Greek Corner Euros, my favorite example for a small business down the street. Can we imagine that they have really, really high inherent risk to the organization? It's like, okay, what are the risks? Well, the risk is that I might give out a cheeseburger instead of a euro. That's kind of the risk they form on a daily basis. That's probably not what we consider high risk from an audit perspective. So, but for most part, we're going to say inherent risks are probably high in most of our scenarios. Control risks are going to be variable depending on what the client has done. Okay. So the auditor determines the appropriate level of detection risk by solving the audit risk model as follows. So we just do a mathematical reorganization. Say detection risk is a function of audit risk divided by risk and material misstatement. Now this has some very interesting implications. What did I say about audit risk just a little while ago with respect to its variance? It doesn't vary. It's a constant. Okay. So if this is a constant, it doesn't really matter what the relationship between detection risk and audit risk is. The only thing that really matters is what is the relationship between risk and material misstatement and detection risk. Now, I apologize. I don't know how to do the fractions in the slide, but imagine this is the numerator, this is the denominator. What does that imply about the relationship between detection risk and material misstatement? Are they direct or are they inverse? That one was a softball, guys. I gave you a real easy one for that one. Are they direct or inverse? Inverse, yes, they're inversely related, okay? So if one goes up, the other goes down. So due to subjectivity involving the judgment of audit risk models components, many accounting firms find it more appropriate to use qualitative terms rather than percentages in the model. So let's just go ahead and look at an example of that to see how it works, okay? Let's see how it works. So I have audit risk set at low or very low, one of those two. Risk and material misstatement is moderate. What is my detection risk going to be? Probably moderate because they're inverse, okay? Because if one's high, the other one's low, and as they change, they move like that, okay? So we're going to say low, moderate, this is moderate. All right. Audit risk is very low. Risk and material misstatement is high. My detection risk is risk and material misstatement is high. Inverse to that is going to be low. There we go. All right. Audit risk is low. Risk and material misstatement is low. Detection risk is going to be risk and material misstatement is low. This is going to be high. Yes. Okay. And then audit risk is very low. Risk and material misstatement is moderate. It doesn't really matter what audit risk is. Moderate is going to be moderate again. Okay. Is everybody following that? There was not a lot of pronouncement in my questions there. Not a lot of responsiveness. I want to make sure everybody's clear on that. Because it's really important to remember that relationship, because if we don't understand that relationship, the next part gets really confusing. Okay. So inverse relationship between risk and material misstatement and detection risk. All right. Now, this is where things get a little bit unhinged. This is something that my undergraduate instructor did not explain very well, and I got confused. This is where you need to pay very close attention because this concept is not intuitive, all right? Detection risk represents the level of risk the auditor is willing to tolerate related to its audit procedures, all right? When we use the word risk, usually when you hear the word risk, is that something that's good or bad? I mean, if you're an investor, you may say, well, risk is good. That means higher return, Dr. Barnes. But generally speaking, If I say two scenarios that are exactly the same, you have to do the exact same task. One is high risk, one is low risk. Which are we going to accept? Low risk, okay? Because you, as risk averse individuals, naturally human, you want to basically choose the best one. So you have a choice of living in Missouri or living next to a volcano, okay? This is the risk. If the rent is going to be the same, you're probably going to avoid living next to a volcano, unless you just like that tropical view. But for the most part, you're going to avoid risk. This does not hold with that. Detection risk is how much risk we can tolerate. All right, how much risk we can tolerate. Thus, when I say detection risk is high, that is a good thing for an auditor. It means that they can tolerate higher levels of risk. If I say detection risk is low, that is a bad thing for an auditor. That means they cannot tolerate very much risk at all. The reason this is important is because detection risk actually dictates the strength, detail, and quantity of the evidence the auditor needs to collect, and it's an inverse relationship. So if my detection risk is high, I'm saying I can tolerate a lot of risk in my procedures. I don't need to do much work. All right. My nature, extent, and timing in my procedures is going to be low. Conversely, if I can tolerate very little risk, I'm going to have to do a whole lot of work to make sure that I address that particular issue, that I don't have that risk. Now, I want you to think about what's happening here, okay? It's not dictated on the slides, but let's think about what's over here to the left. What is it that's setting detection risk to high? It's that risk and material misstatement that we said is low, because risk and material misstatement would have to be low for detection risk to be high. If risk and material misstatement is low, what would you naturally assume about the level of work that you would have to do in an audit? Would that have to be high or low? Client's not got a lot of risk associated with their operations. They're doing a very good job. They've addressed all their risks properly. Their controls are good. So what does that probably mean for the scope of your audit? Don't have to do much work, okay? Now, down here, where it says detection risk low, probably is going to be a risk and material misstatement of being high. So the inherent risks are high, their controls are in place, but they're not working properly, not very good. So we don't believe that the client is giving us much assurance. What does that mean about the work that you're going to have to do as an auditor? You have to do a lot more work, okay? Does everybody understand the intuitive associations there? It makes sense if you understand that detection risk represents a tolerance for risk. If you try to think of detection risk as risk itself, you're going to get really confused very quickly. So this is why this is so important to dictate. But once you understand that point, then the associations make a lot more sense, and making that determination is a lot easier. So this is very important to understand. This is the key to understanding the audit risk model right here, okay? So making sure we understand how it actually determines the work that we're going to be doing. Worried that I'm running out of time, and I've got 17 minutes, so we're in good shape. All right. So to properly assess the risk and material misstatement engagement risk, the auditor needs to understand management's objectives and strategies and the related business risks that may result in material misstatements. Now, you've probably heard the term business risk. In fact, I know you have. These are something we talked about in AIS. When we talked about the nature of business risk, these are going to dictate a lot of the way that the organization is structured and built, all right? So we can generally characterize business risks as something that contributes to inherent risk in an organization. To that being said, business risk is definitely a broader concept than the risk and material misstatement, but most business risks have the potential to affect the financial statements either immediately or in the long run. All right, so let's think about one that's probably very, very pronounced, okay? This actually goes back to the kind of some of the things that we talked about with respect to in the controls framework back from 360s, Accounting 367 back from AIS. Does everybody remember that the COSO internal control integrated framework? If you've forgotten about it, don't worry. I'm going to introduce it to you again. Okay, we're going to talk about it again. But the last component was monitoring. Everybody remember monitoring? What was the goal of monitoring? Why do we have monitoring of internal controls? Because things change over time, and so we need to be able to address the risks that change over time. This is kind of the same idea here, is that we need to be able to understand how do business risks change over time. One big one, okay, back in 2000, something happened that was a big worldwide event, okay, back, it was like March of 2000, right before, or actually, it was right after spring break here at Truman State. I remember because I went to spring break to see my family. I came back and said, yeah, classes are canceled. Nobody's coming back to campus. So, oh, well, that's weird. Okay. What was that thing I'm talking about? The COVID pandemic. Yeah, the pandemic. How do you think that affected operations for many companies within that time period? I know for you all, it's just kind of like, oh, we're doing classes via Zoom. Well, that's going to be awkward, but yeah, most of you were in high school at the time, or around that time period. Did you go out to see a lot of movies right around the time? Go out to hang out at the Cinemark movie theater? Spend a lot of time in the grocery store, over at the malls, just hanging out with friends? Not really. It kind of adversely impacted the way that operations worked. So keep in mind that that's a business risk, but that also impacts to how we consider inherent risk and how we consider the nature of risk in an organization. This was probably not inherent risk that many organizations had on their radar. And we know that they have to implement control risk to respond to risk. So they probably had no controls for responding to this either. So we understand that business risk can very, very catastrophically affect operations if they're not dealt with. And this was an example of one that nobody saw coming. A lot of companies adapted in a very, very short time frame, but some companies were really in dire straits. The example that I've talked about in other classes is the movie theaters. If you're a movie theater chain, how did you respond to the pandemic? How did you even survive? A lot of answers, a lot of movie theaters didn't. A lot of them had to close down because of that. So something that kind of represents the idea of business risk within that context. All right. Let's talk about something that's going to be a reflection, something we're going to have to look at move forward, okay? We're going to talk about preliminary risk assessment procedures. So risk assessment will be the first phase of the audit where we can actually gain assurance from our testing. Now, I want to make a quick delineation, which will make more sense next week, but we're not gathering information about assertions yet. We're not testing assertions directly yet, but we can perform some tests to actually gain assurance. Now, we're not going to talk specifically about these types of evidence gathering, but they should be fairly intuitive right now. We're going to go into much more detail and depth next week on these. First of these, inspection of records and documents related to the business and operations of the client. Okay. So we're going to look at whatever accounting records they put together and something that relates to their information and produced by the system, and we're going to review those. Next, we're going to observe personnel and processes in place at the organization. We're going to make sure we understand how their operations work and what their routines are. Then we're going to perform inquiries of people within and outside the entity. So definitely talk to people in the organization, and if necessary, you can talk to people outside of the organization to get understanding of their processes. Finally, we're going to perform preliminary analytical procedures. Now that one's not very intuitive because you've never heard of analytical procedures. We're going to state right now, analytical procedures are basically gaining high-level understandings of quantitative information. Basically, the understanding that we gain from that quantitative information will dictate what things we think, what areas of the audit we need to focus on, or what accounts we need to focus on, for example. And in some situations, develop estimates for us, though usually that's not done at this phase. Second part of chapter 5, we're going to get really in depth onto analytical procedures and what those represent. Preliminary analytical procedures are generally pretty straightforward and pretty simple. They involve simple transactional analysis like ratio analysis, not transactional, simple quantitative analysis like ratio analysis and trend analysis. You guys did back in 221 did company financial statement analysis, like corporate financial statement analysis, I think. We had to look at a 10K and you had to develop ratios and had to look at trends and develop those comparative financial statements, horizontal analysis, vertical analysis. Those are all examples of kind of things that you would do for a preliminary analytical procedure. So familiar. Now, I want you to make a note of these. These are actually 4 types of evidence. These are the 4 types of evidence we can gather during this phase of the audit. When we get to next week, we're going to talk about 3 evidence collection phases of the audit. This is our first one. I only bring this up because this is appropriate for this phase, but we're going to come back and reflect on this. And we're going to talk about what these represent and what they're attempting to do. But it's important to note that as we start talking about the phases of the audit, I'm going to be very insistent that you remember what types of evidence we can gather during the phases. So might even test about it. Who knows? I've done it in the past. Who knows? We'll see. All right. So let's just talk very quickly about the overall context of what happens with risk assessment, okay? So we know the entity's risk assessment is part of that COSO framework that we've talked about before. Why is it so important? Well, the auditor needs to obtain information on the risk assessment process and whether it's operating effectively. If the entity's response to identified risk is adequate, the risk and material statement may be reduced. What does that statement even mean? It's a little bit cryptic, okay? So we know that risks exist. We know the company has to identify those risks. Why do they have to identify those risks? They have to implement appropriate controls. So if a company implements appropriate controls that are both designed and operating effectively, what is that likely to do to risk and material misstatement? Is that going to make it go up or go down? It means the control risk will be lower, and we know lower control risk will make risk and material misstatement go down, okay? So if risk and material misstatement goes down, that's a good thing for us, okay? Because we as auditors can say, hey, controls are great. I got less work to do, okay? What about if the entity's response to the identified risk is inadequate? That means the auditor's assessment of risk and material misstatement, it may increase. So we walk in, we look at controls and say, they look okay. I could say that they're moderate, okay? It means my risk and material misstatement is probably moderate. Then I start testing controls and I realize that they're just ignoring controls all over the place. Some controls are not present that I thought were present. The controls are just a nightmare. So I have to set control risk. I have to revise control risk assessment to high. What does that mean probably for risk and material misstatement? It's going to go up. Risk and material misstatement goes up, means controls are bad, everything's bad. I got a lot of work to do as auditor. Got a lot more work to do as an auditor. If the entity does not respond adequately to business risk, the auditor will have to develop tests to determine if any misstatements are present in the related account balance or disclosures. Now, this is an interesting statement because this actually underpins the sequence that we're going to see as we move forward. If you remember, we talked about phases of the audit earlier. We talked about it in chapter 1. I think I reiterated this as chapter 3. Said we've got our engagement, acceptance, and continuance, which we already done. We're in the middle of planning. What comes after planning? Does anybody remember? That's where we do test of controls. So we perform test of controls. After that, once we complete test of controls, we go into this phase called substantive procedures. And substantive procedures are basically any additional information we need after we've completed test of controls. So what happens if test of controls are bad? If we test controls and the controls themselves are bad, or for some profound reason, which we'll talk about why that might exist, we just bypass test of controls altogether. What does that mean about the additional work we have to do? It means we have to do a lot more work to gain more assurance. So this is just basically dictating, saying we have to document our conclusions in each of these steps, because each of these steps will actually have a profound impact on the amount of work we do to conclude the audit. If I'm in the situation of being an auditor again, I would rather do less work than more work. I've definitely had my 80-hour work weeks. Those were not fun. I've also had 40-hour work weeks during busy season, preferring 40 hours versus 80 hours. Now, I don't know. I did have a colleague in the PhD program who said there was utility to be gained from doing extra work, okay? Does anybody in this room agree with that statement? Just gaining additional utility? If so, I can give you extra homework, okay? But I'm going to assume that most of us would agree that doing less work is going to be preferable to more work. So if that's the case, we need to be able to document this, and we're going to be able to have to try to make sure that we understand it. Now, chapter 6 is going to provide a coverage of the entity's risk assessment process. It's going to be as a whole the understanding of what we're going to be doing as part of as part of our assessment of control risk. But we're going to get into a lot more detail about how this risk assessment dictates the work that we do within later chapters. All right. So in order to assess the risk of material misstatement, we need to understand the nature of misstatements, okay? So we need to get into depth on that. And to suffice to say, the nature of misstatements will vary depending on whether they're intentional or unintentional. That being said, when I looked, we only have 5 minutes left in class. And that was planned because I'm going to say this is to be continued. So this is where we stand for next class period. We're going to talk about the nature of misstatement and how an auditor has to change their procedures based on what types of misstatements are going to be present. But for now, we're done. I will see you all on Wednesday.